Can we all see that wonderful word, recession? Okay, yeah, so Lorna and John asked me to talk about recession, which, yeah, that was really nice doing the prep for this. Didn't depress the hell out of me at all. But what I thought I'd do, in terms of agenda, I'll kind of give you an overview of kind of what recession is. So the first thing we kind of need to understand is gross domestic product, GDP. Obviously a phrase we hear bandied around sort of a lot within the media. I will go into sort of what a recession is, just so people kind of understand that. We will have a look at kind of what causes recession, so you can kind of probably understand how the current situation is very much indicating that way. I'll give you an overview of recent historic recessions, because I think that's useful in terms of a kind of frame for what's happened in the past. Are we heading for one? I think we probably all know the likely answer to that one. And lastly, any positives. I wanted to try and finish on some positive notes. I put a question mark, but yes, I did manage to kind of eke out some positives. You'll be pleased to know. So yeah, there's a little kind of rainbow to go with that. My wife helped me with some of this. Okay, so gross domestic product, GDP. It is basically a measure of the output of an economy as a whole. In the UK, it effectively measures the total market value of all closing or finished goods and services produced domestically during a calendar year. There's a couple of other measurements as well, which will be used, but this is the main one where the sort of initial estimates kind of come from. It's reported in two ways, so you generally hear two figures: the percentage change of the most recent quarter of reference, and then compared to the same period a year ago as well. Figures are always delayed, reviewed twice more after the initial figures are released. When the first kind of figures come out, there's usually around 60% of the data available, and the UK is actually one of the kind of fastest countries in the world in terms of sort of issuing its initial GDP estimates, which come kind of 40 days after the end of the quarter in question. So what is a recession? It's effectively it's a significant decline in economic activity that lasts for months, sometimes, or even years. So negative GDP, rising levels of unemployment, falling retail sales, contracting measures of income, and manufacturing that effectively runs for an extended period of time. A technical recession is called following 2 consecutive quarters of GDP contraction. When you get a technical recession, it doesn't necessarily mean it's going to lead into a full-blown recession, but that's usually when you know, governments, etc., will admit there is actually a recession. So what are the causes of recessions? A decline in real incomes is obviously a big one, and something that we are experiencing right now. This is obviously around income growth compared to rising inflation. We're obviously seeing the discontent that is happening around that. You know, we've got the rail strikes now going on. You know, there's lots of talk that there's going to be further industrial action in other sectors, and at the moment that seems fairly likely. World events can kind of kick off recessions as well. Obviously, COVID was a very good example of that, and conflict around the world is obviously another issue that can sort of kick things off. A lack of investment confidence. Obviously, when such issues start happening, companies start to lose confidence in investing in growth. They tend to hold on to cash, so that kind of tends to have a further effect on the situation. Stock market falls. Obviously, we then see the markets falling as confidence in companies drops and people start selling riskier assets. And rising interest rates, which again is something we're starting to experience. So those kind of create a cocktail of kind of negatives that will you know push us into recession. So recent historic recessions, I didn't want to go back too far, but I thought if we went back to the early 70s is as far as I wanted to go, really. But the early sort of 1973, 4 and 1975, we were, at that point, inflation was running at 9.2% and actually peaked at around 24% in 75. Interest rates were fluctuating hugely, but between 9% and 15%. So again, you could see interest rates were extremely high. In terms of the duration of that one, it lasted, the first bit was about 3/4 of a year, and the second duration 3/4 of a year, and half a year. So it was about a year and a quarter in total. It took, after following that recession, about 4 years effectively to return to the level of growth that was being experienced before the recession. So yeah, 3 years, 2 months. Right, then we had the 1980 to 81. Again, the big emphasis here, inflation hit 18% in 1980. It was reduced down to 4.6 by 1983, and again, interest rates extremely high at that point. Well above anything that we've experienced in an incredibly long time, and had gone down to 9.6% by October 82. But again, that was a slightly longer one in terms of getting recovery to the pre-recession peaks. We've then got 90 to 91. Again, you'll see there's a common thread here. Inflation again hitting 9.5%. It did get reduced down to 1.6% by 93. Interest rates again extremely high, at 14.8%, but were kind of reined in by the end. 2 years, 9 months it took to recover from that one. And then we've got the 2008 to 9, known as the Great Recession, which was the financial crash. This technically only lasted 1 year and 3 months, so it was relatively short, but it was the greatest kind of economic contraction since the recession following the Second World War. So it was extremely significant in the actual drops that happened. It was mainly caused by excessive risk taking in the subprime mortgage markets in the US. And this kind of caused a domino effect, hit the worldwide banking system, fall of some big financial institutions. We've already mentioned about Lehman and of course Northern Rock. And a credit crunch. I was purely doing mortgages at this particular point, and I can remember, pre this, we were doing mortgages with Northern Rock. They were lending 125% of property values. It was crazy. After this happened, suddenly there were mortgages that you couldn't get for more than 60% loan to value, and you were paying kind of 6-7% interest rates. So it was very dramatic. We then had the 2020 COVID-19 recession. The main contraction was in March and April, obviously due to the lockdown, and it only actually lasted for 2 quarters in terms of recession, because there was such a kind of bounce back. So it was, the definition of a technical recession, and we returned to pre-pandemic levels by the end of 2021. So as I say, it was relatively short-lived, although it didn't exactly feel like it. Okay. Right, are we heading for one? So the GDP quarterly figures for the first quarter at the end of March, 0.8%, an increase, so I've already gone over 10 minutes, increased by 8.7% compared to the quarter 1 of 2021. However, the latest monthly figures available, so these are for April, showed a contraction of 0.3%. And though the Bank of England's not technically predicted a recession, they expect significant downturn by the end of the year. So it does seem likely, but I think it's probably going to not be officially recession, maybe into the start of next year, although it could be the end of the year. We've got energy, fuel and food prices continuing to increase significantly. The energy price cap increased in October. We haven't really got an end in sight on the Ukraine war. We've got those falling stock markets. We've got those supply chain issues. Brexit continued to provide challenges there. We've got national strikes causing further disruption. And just for Lorna's benefit, I thought I needed to put the word stagflation in there for her. which effectively is an increased inflation combined with stagnation of economic output, which is what we are effectively experiencing right now. So the positives. Interest rates, they still are at a historic low. You know, compared to other recessions that we've had to deal with, they were significantly higher than they are now. So we do, you know, we've got a fair amount of wiggle room there. You know, if interest rates were at a higher rate, the Bank of England would probably still feel pressure to increase them, because it's one of the few mechanisms they have to control inflation. So, you know, at least we're coming at a low interest rate point, so we're not being hit so hard on that side of things. The banks are much better capitalised than they were, you know, following the 2008 crash. You know, there has been considerable changes in oversight and regulation to make sure that, you know, the issue of a credit crunch or credit availability should not become an issue. Unemployment is low. It stood at 3.8% at the end of April. During the 80s recession, it hit 11.9%, 10.7% during the 90s recession, and 8.3% during the Great Recession. Obviously, it can potentially go up, but we're at a much lower point again than where we were in previous recessions. And the last thing to say, recessions are, you know, they are part of the business cycle. They have to take place to kind of reset the economy and tend to be relatively short-lived. So, you know, we will get through it. I'm afraid it is going to happen. You're probably going to ask me how long I think it's going to last. You know, at the end of the day, I don't know. I really don't know. There's so many issues going on that could impact on it. You know, the big one being, I think, an outcome to the Ukraine war, that getting concluded in some shape or form. And that is it.